There is a number that changes everything, not because it is large, not because it is rare, but because of what happens the moment you reach it. That number is $10,000, not $10,000 in a checking account, not $10,000 saved for a vacation, $10,000 invested, working, compounding, growing without you. Most people spend their entire financial lives never understanding why this number matters. They save when they can. They invest when it feels right. They wonder why the results never compound the way the charts promise. Today, we close that gap. The $10,000 rule is not a secret. It is a framework. And once you see it, you will never manage money the same way again. The $10,000 rule is this. Every time you accumulate $10,000 in investable assets, that money is never touched, never spent, never borrowed against, never raided for emergencies. It is deployed into a diversified, long-term investment vehicle, an index fund, a retirement account, a brokerage account, and then it is left alone. The rule has three parts. Part 1, the threshold. $10,000 is the minimum meaningful unit at which compound interest begins to produce noticeable, motivating results within a reasonable time frame. Below $1,000, the returns are too small to feel real. Below $5,000, the momentum is too slow to sustain. At $10,000, the math begins to speak in a language people can hear. Part 2, the deployment. The $10,000 is not saved, it is invested in assets that have historically returned 7 to 10% annually over long periods. The S&P 500 total market index funds, low-cost, diversified, and time-tested. Part 3, the non-negotiable. Once deployed, it is untouchable. Not for a vacation, not for a car down payment, not for anything that is not a genuine life emergency. The rule is not about the number $10,000. It is about the habit of building untouchable investment units, one at a time, until the portfolio is large enough to compound without your help. Numbers do not lie. Let them speak. Scenario 1. $10,000 invested at age 25. At 8% average annual return, age 35, $21,589. Age 45, $46,610. Age 55, $100,627. Age 65, $217,245. One $10,000 investment made at 25 becomes $217,000 by retirement. You did nothing after the initial deposit. Scenario 2, 5 $10,000 units deployed across your 20s and early 30s. Total invested $50,000. Value at 65, over $1 million. $1 million. From $50,000 from 5 deliberate decisions made before age 35. This is the power the $10,000 rule is designed to activate. Not one massive investment, 5 intentional ones, built one unit at a time. Now compare to the person who keeps that $50,000 in a savings account at 2% interest. Value at 65, approximately $91,000. Same $50,000, same 35 years. $91,000 versus $1 million. The difference is not income. The difference is the decision of where the money works. The first $10,000 is the hardest. It is also the most important, because every unit after the first is funded partly by compounding returns from the unit before it. The momentum builds on itself. But the first one, that is entirely on you. Here is the system that works. Step 1. Open the right account today, not next month. Today, a Roth IRA if you qualify. A 401k with employer match, always first. A brokerage account if the others are maxed. The account structure matters. Tax-advantaged accounts let compounding work without the annual tax drag. That drag, over 30 years, costs you tens of thousands of dollars. Step 2, automate the contribution. Set a fixed transfer every payday. The amount is less important than the consistency. $200 per month reaches $10,000 in 50 months. $400 per month reaches it in 25 months. $600 per month reaches it in under 17 months. Pick a number, automate it. Never see the money before it is invested. Step 3, accelerate with found money. Tax refund, go straight to the account. Work bonus, split. Half to lifestyle, half to unit. Side income, directed to the $10,000 target. Sold something, add it to the fund. The goal is singular. Hit $10,000 invested as fast as possible. Then deploy it. Then start building unit 2. Each unit you build is a machine that runs without you. 5 machines running simultaneously is financial independence. 10 machines is generational wealth. Most people never reach the first $10,000. Not because they cannot, because 5 specific traps drain the balance every time it builds. Wealth killer 1. No emergency fund first, without 3 to 6 months of expenses in a separate liquid account. Every car repair, every medical bill, every unexpected cost raids the investment account. The $10,000 never holds. Build the emergency fund first, then start the investment units. Wealth killer. 2. High interest debt running. Simultaneously, credit card debt at 22% interest is a guaranteed minus 22% return on every dollar you hold instead of paying it off. No investment reliably returns 22%. Pay down high interest debt first, then direct cash flow to building, then direct cash flow to building units. Wealth killer. 3. Lifestyle inflation on every raise. Every time income increases, the standard of living increases to match. New car, bigger apartment, more subscriptions. The gap between income and investment never widens. The $10,000 target never gets closer. Cap lifestyle upgrades at 50% of each raise. The other 50% builds the next unit. Wealth killer. 4. Treating investment accounts as savings. A 401k is not an emergency fund. An IRA is not a down payment account. Early withdrawals from retirement accounts carry 10% penalties plus full income tax. You lose 30 to 50% instantly, and you lose every dollar that money would have compounded into. Once it goes in, it stays in. Wealth killer. 5. Waiting for the perfect moment. I'll invest when the market calms down. I'll start when I get the promotion. I'll begin after the holidays. Time in market beats timing the market. Every month of delay is compounding that never starts. And compounding that never starts cannot be recovered. The first $10,000 is not blocked by income. It is blocked by these 5 decisions. Remove the blockers, and the path to the first unit becomes a straight line. The real power of the $10,000 rule is not a single unit. It is what happens when you stack them. Think of each $10,000 unit as a separate engine. Each one, once deployed, begins generating returns independently. When you have 5 units running, $50,000 at 8% annual return generates $4,000 per year in returns. That $4,000 alone is almost half of a new $10,000 unit, created by your existing investments, not your labor. When you reach 10 units, $100,000 at 8% generates $8,000 per year. Your portfolio now builds itself by $8,000 annually, even if you contribute nothing. When you reach 25 units, $250,000 at 8% generates $20,000 per year. Your investments now earn more than many Americans make in monthly take-home pay, passively. This is the inflection point. The moment the portfolio stops needing your paycheck to grow meaningfully. The moment the machines begin feeding each other. The milestone map. Unit 1, $10,000. The beginning of momentum. Unit 5, $50,000. Compounding becomes visible. Unit 10, $100,000. The portfolio grows $8,000 per year alone. Unit 25, $250,000. Passive growth exceeds many salaries. Unit 100, $1 million. Financial independence threshold. You do not climb this ladder all at once. You build one unit, then one more, then one more. The compounding does the rest. The $10,000 rule is not complicated. It is not a sophisticated strategy reserved for the financially educated. It is available to anyone who is willing to treat $10,000 as a unit, not as a ceiling. The wealthiest people you will ever meet did not build wealth through one big move. They built it through one repeated move, made consistently across decades. One unit, then another, one machine, then another, until the portfolio runs faster than the bills arrive. Your first $10,000 invested is already worth $217,000 at retirement. If you start today and never touch it, that is not motivation. That is arithmetic. Open the account, set the transfer, build the first unit. The compounding will take care of the rest. If this gave you a framework, share it with someone who is still keeping their money in a savings account, wondering why it never grows. Subscribe for more.